Welcome back. You're watching HFO TV.
Please welcome Jerry Johnson.
So what I'm going to talk about is some of the broader macro trends in the market. Coming into this, I think I did this forecast a few years ago. One of the rare times I was right, so I'm probably going to be insufferable today because when an economist is right, you'll hear about it. It doesn't happen a lot, but it did this time. So when we take a look at the economy's in a nice, progressed, nationally it's been a relatively modest but sustained recovery. Locally it's been a little bit stronger. Typically when the national recovery or the national expansion cycles are going on, the Portland metropolitan area grows at almost twice the national average, about 1.5 to 2 times the national average. That trend is continuing. It's a nice backdrop in that it creates a pool of demand. If we break out the employment growth, this is the spaghetti chart that says a lot of stuff's going on by sector. If you simplify it, what really happens in our recoveries is the real high beta sector is construction industry. And this is a very atypical expansion cycle for us because it's not the single family home building industry that's the construction, it's the multifamily rental apartments that's the construction employment in this. Nonetheless, we've had a growth in construction employment. It's a little bit different in nature, but that's really been driving. Everything else is expanding at a relatively modest rate, but construction tends to be the big leading indicator, both on the upside and the downside. So construction employment continues. Again, it's a little bit atypical, and a lot of the product we've had, particularly early in the cycle, has been downtown urban product that has a different construction profile than a typical single-family residential. Construction employment, we're starting to feel some pressures from this. You'll hear later, or you talk to anyone who's trying to do development, construction costs are going up a lot. We're late in cycle for construction, and it's getting very difficult, and it's putting a lot of pressure on pro formas. Unemployment rates are going down nice and steadily, national, statewide, Portland metropolitan area. A lot of this was somewhat people leaving the labor force. People are back in the labor force again. Normal rates, we're starting to get to the point now we're starting to get wage escalation, wage appreciation. If you're a small employer, that's potentially a problem, but for housing, it's a positive because we're talking about a greater ability to spend as wage rates start to rise. So median family income trends, in the Portland metropolitan area, income is up over 6.5% in the last year. So this is the first year in this cycle where we actually have income growth exceeding rent growth. And this is sort of what we've been waiting for to happen. When I say I was right, what I was right about a couple years ago is I thought the latter half of 2016 is when our supply was going to catch up or we're going to stop seeing above normal escalation rates in rental apartments. And same time, we're getting to the point where our labor force is tight enough that we're starting to see real growth in ability to spend on rent. So affordability is actually not getting worse, it's starting to get better. Strangely, this has all coincided with a bunch of probably ill-advised measures to increase affordability will take pressure for the fact that of things that the market basically did on its own, and the market's been doing for the last decade. So new apartment supply since 2012, in this particular production cycle, it's really been concentrated in the urban areas in downtown. At least in the first wave of that was, we've seen some transitions more to the suburban communities since 2015, 2016. We're still seeing a lot of downtown supply. We track a pipeline. We have about 42,000 units currently in the pipeline. And of that pipeline, we saw a big surge in the last quarter trying to get ahead of inclusionary zoning in the city of Portland. So the city of Portland sort of has an anomalous situation right now where a lot of the production to get ahead of the IZ zoning sort of jumped the gun to get grandfathered in. This is a little mix of the little profile of where unit introductions, these are when they actually deliver market relative to long-term demand. Now that demand line should be higher. In this expansion cycle, that demand line, the little dotted line, should be about 5,000. This was done for over a 10-year period, but there's a 10-year period included the downturn, which is really hopefully anomalous as opposed to typical. And so if you take that in and put about 5,000, we're still in a situation where we're starting to oversupply the market relative to the underlying demand pool if you take traditional metrics of how demand goes. which would mean softening markets. Softening markets means softening rents, increased concessions, all those things that we tend to see. Apartment deliveries, again, are transitioning a little bit more from the urban to the suburban. On the margin right now, we're starting to see some real action over in Clark County now, getting a lot of new supply. We're starting to even see some stuff out. The west side saw a lot of supply in the last few years. Now we're starting to see some looks to the east. The east is largely suburban east has been overlooked. All the urban stuff is there. The urban stuff has gotten to the point where the prices are so high, it's really hard to make these things work anymore. So we see this transition a little bit more towards the suburban over time. We expect that will continue. There's an anomalous thing where it goes backwards in 2018 deliveries, but a lot of that's because of people who jumped the gun to get grandfathered before the inclusionary zoning in the city of Portland. So vacancy rent growth. About a year or so ago, the old mayor asked me, when are we going to see rent growth start slowing down? I said, well, when your vacancy rate gets closer to 5%. And that's always how it is. And it's just that simple. I mean, you try to make this thing complicated, and it'll look more complicated as I finish up here, but in reality, that's all it is. If it's a renter's market, the vacancy rate's a little bit higher and people are competing more for renters. If it's a landlord's market and the vacancy rate's 2%, any idiot can get rent increases if they want, and you don't have to worry about what your product is. So cumulative rent growth, suburban, urban, we saw close in Portland take off like crazy. Rents way higher in close in Portland. Now in the last year, we've given them some of those rents up. And we're seeing the suburbs now take up, and there's a lot of gap to close there with the suburbs. We still think there's a lot of play left in the suburbs. Urban is still strong. People like to live in the urban locations. What happens is because of the price points, first, everyone ends up paying too much for land now, all the additional things, burdens on top of it, construction costs going up. It's just harder and harder to deliver urban product at a price point that you can actually make it work at anymore. So those are getting harder to do, but the suburban, there's still some play there on the new construction side. One of the real issues for us is how significantly are we overbuilding, and that's been the big question for us, and that's presupposing we're overbuilding. But if we take a look at home ownership rates, that's one of the biggest issues that has affected this particular cycle. In the previous cycle, no one built apartments, everybody built condos. Homeownership rate went from 65% to 69%. Every 1% change in the Portland metropolitan area is about 8,000 households that go from ownership to rental apartments. So if I take a 10% move, and that's basically a 10% move in the market, that's 80,000 units that I can support in new rental apartments with nothing, except I just moved the homeownership rate from 69% to 59%, which is actually in the metro area is pretty close to what we've done. The question is, what does this mean long term? What's the aberration? What's the blip? Is it a change in how people are consuming and what people are doing? And so the little orange line here is the actual data on homeownership rate, and then we try to fit a bunch of curves to it. A nice polynomial curve fits it the best, but that says nobody will rent by 2017, which is probably unlikely. There's probably another fluctuation in there. So typically when you do these curves, you have more and more curves, more of a cyclical nature than fitting it. I can grade, in statistics, I can prove things that are demonstrably false. I can demonstrate that they're true, even though they make no sense whatsoever. I can demonstrate to you in statistical significance completely absurd statements from this. We do expect that there's probably a little bit of a pushback, but some of the home ownership rate things we do think are much more structural, which means they're going to stick and it's going to be good for the industry long term, and we're not going to overbuild as much as it might seem like we are. A lot of it's the difference between baby boomers and millennials and how these things end. We've already spent time on the different tastes of these. What's really happening is the population, for a lot of reasons, some may be student loan, some may be, whatever societal norms, we're extending that period where people are prime rental years. The, pre-kids, maybe pre-marriage. A lot of things, people are basically changing jobs 5 or 6 times in the first 10 years of their professional career. You've got a lot of things that basically put people in the position where renting makes more sense than ownership for a longer period of time. And so while typically by the time you were 34, you'd be in a single family home back in the baby boomer days, and you'd be married and you'd have kids, and you'd look like the top left couple here, that would be you then. Now you got a dog, and you may or may not have a partner, and you rent, and you work for a tech firm, and that's your third firm, and you've 4 years out of school. And all the moving costs from ownership housing is really onerous because I may get transferred somewhere else anyways, and I'm not sure what I want to do, and the realtors have more and more difficulty convincing me that I can't lose in housing because I saw people lose a lot in housing not that long ago. So I'm ready to rent for a longer, more sustained period of time. The good thing for renters is that just means instead of us overbuilding, which basically we've changed the nature of how the population consumes rental housing, or housing as a whole, and what percentage rents. This is a rental apartment rent gradient we've been developing in-house. The big issue is marginal rents for new construction. Where are my rents? Where are my hot points? They still tend to be downtown and urban product. But there's increasingly hot points out in the suburban communities that get us pretty good rents. And if you actually match this up against where we're actually seeing new product, there's actually opportunity points where there's pretty good rents and people aren't catching on to the fact that there's good achievable rents in markets that have largely been overlooked. So 5-year rent growth, high, right, everywhere. 3 years, a little less high. 12 months, we're slowing down. And 6 months, we're starting to give some up in more broader areas. This is not atypical. We're still up over 5 years. You're well ahead of point. If you've been holding property for 5 years and you haven't refinanced with really aggressive assumptions. But for the other people, yeah, I mean, there's a lot of stress in this market right now. This is a market now where you've got to be smart because it's not a market where, again, any idiot can do well. You've got to have the right product, you've got to have the right management, you've got to be in the right markets, you've got to be positioning, and you've got to be cognizant of what the appropriate pricing are. We've had clients, one of the classic client statements, and I get this at least 2 times a cycle, where they say, you know, we beat the rents you said we'd get, but our absorption's been slower. It's almost like there's this magical relationship between pricing and demand. And you can price things whatever you want, but at some point you really do have to get real. Now, concessions are always difficult. And concessions is a zero-sum. It's a terrible game to get into in this whole concession spin because you start getting into a softer market. And if the market's at a point where we're going to go to an 8% vacancy rate, and you decide, I don't want to go to 8% vacancy rate because my owner is giving me pressure to keep it at 5% vacancy or less, so I start giving up, concessions were 20% of my rent, and then my neighbor does, we're still at 8% vacancy, except we all got 20% less in rents. And that's really what comes into all these cycles. And so, to some extent, it's trying to stop the herd mentality and more of a lemming mentality of don't undermine yourselves. This isn't a market people should be panicking dramatically. They need to be priced appropriately and be careful on the downside not to, just panic on this thing. Studio units, 5 years. Some of the things we see, some of these fluctuations in this map, it shows Hillsborough really weak. It's really weak because there's one project in this particular sample. And so sometimes they don't work well at the submarket areas. 1-bedroom units holding in pretty well. 2-bedroom units, same way. Rents by unit type, different markets. They're really hanging in there pretty consistent. Close in the suburbs, we're seeing that originally it was the downtown coming in. Now we're seeing the suburbs coming back pretty strong. And we still think there's more run in the suburbs than there is downtown, probably as far as rent growth. Product vintage, you get what you typically get is the pre-1990 product is basically the one that's been holding in the most consistently on rent growth because they've got a low basis that's taking them a long time to basically adjust to what they can get in the current markets. One of the things we take a look at is where's the employment growth and what's the nature of employment and wage levels and income levels. This is where it looks complicated. The top line is basically the age cohort of population. The left-hand column takes a look at the household income ranges, and it takes a look at employment growth in different income ranges. This one at the metro area, what you see is you've got growth in the 25 to 44-year-old making $50,000 to $60,000. That's a good rental market, and it's a good rental market for a relatively robust rent profile. You're losing people who are 45 to 54 making 40 to 50, but that's not a rental market, so that's okay. We take a look at this in different counties, and you start to see some different trends, and this is it over time. In the downturn, you'll always see this big red in 2009 where everybody lost jobs, broad-based. What happens in the metro area is we're starting to see employment growth And the employment growth is in the 25 to 44, which again is a good rental demographic. Washington County actually does less than you'd expect on this. Even though it's got very strong employment growth, the Washington County employment is higher wage, and it has older employees who make actually pretty good wages. While it's a great market if you're building single family, it's not as much of a rental market as you think it would be. If you take a look at Clark County or Multnomah County, those are prime rental markets. They're getting a lot of growth in rental demographics. Same with Clackamas County. The big issue for the housing supply, and the home builders this winter, the home builders aren't building any housing. So we talk about, are we over or under building housing for rental apartments? Typically in an expansion cycle, we're adding 30,000, 40,000 jobs. We'll knock out 15 to 18,000 residential units, of which 5,000 to 6,000 would be rental apartments. We're knocking out 6,000 to 8,000 rental apartments a year, and we're knocking out like 3,000 or 4,000 single-family homes. The single-family housing market, well, now it's not even single-family. Increasingly, you have to do attached product to get to the price points anyone can afford. Ownership housing market has been really slow out of this recovery, and they're finally starting to get some traction. They're finally getting some land supply now with South Hillsborough coming online. Bethany's finally got their financing problems working out, South Cooper Mountain. We're going to see some actual housing production for the first time. But in essence, when it comes to actual residential units, we don't have enough residential units. We may have enough apartments, but we don't have enough residential units. So there's a lot of growth still going on the residential side. So cumulative supply of residential units, even if the home builders take off and start building like crazy, which we expect them to be doing, we're not going to get back till about 2020 till we actually get to some level of balance in ownership. This is, to some extent, what concerns us a little bit is one of the reasons so many people renting is they can't get into ownership. But the great thing is, since we're not going to have enough ownership housing, you can't get to ownership. The pricing's going to keep going up because they can't deliver enough product. So the ownership market's still going to continue to get more expensive, and which gives the rental market a little bit of room. So the overall trends, this is stuff we've shown before, which is basically when vacancies are high, rent growth goes down. When vacancies are low, rent growth goes up. Vacancies are starting to get higher, rent growth is going to be lower. We don't see a disaster scenario. We don't see things are going to fall out. The sky's not falling. But it is a situation now, if you've got pro formas, then you shouldn't be pro forming with a 7% assumed rent escalation. That worked for you about 5 years ago, but that's probably not where you want to be. So looking forward, we've got a strong economy. It's healthy. We're assuming the expansion continues to go. You know, it is late. It's long in the tooth. We're hoping that keeps working. Demographics have really favored the apartments. People say, what happens when the millennials grow up and they start getting into homes? Fortunately, the millennials are growing up really slowly, so that's going to favor us for a little bit more time, but that is something to worry about long term. The metro area, Portland Metro is now an investment grade market, which means we're not flyover country on the West Coast. It used to be no one had to be in Portland. We actually have a lot of national groups that want, presence in Portland or looking for things in Portland, which means we get the advantage of a lot of investment capital and, really competitive cap rates. We're late cycle for urban housing. And a lot of it's not that people don't love urban housing. People have always loved urban housing. Urban housing is expensive to deliver. There's opportunities in suburbs still. Replacement costs are going up. Replacement costs going up, that's the pressure on rent. Includes construction costs are clearly going up. The IZ zoning, if we start talking about rent control or other pieces, those are issues that basically increase replacement costs. Increasing replacement cost over time increases the cheap rents. And interest and cap rates, we know interest rates probably aren't going lower. They tend to be going higher. When interest rates tend to go higher, cap rates go higher. When cap rates are down below 4%, modest rises in cap rates have a big impact on value. So I'd keep an eye on that. I think that's what I got. Thanks.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.